Imagine you're an elite financial detective. You've just been handed the massive, sprawling books of a giant multinational corporation. I mean, where do you even begin looking for the truth hidden inside all those numbers?
So, how do auditors actually tackle a massive corporate audit? The sheer scale, the chaotic and complex nature of a modern corporation's finances. You can't just dive in and start randomly checking receipts. To mitigate total disaster and actually uncover the truth, auditors need a highly structured, step-by-step procedural solution.
Okay, let's dive into this. Here's our investigative roadmap for this explainer. We'll trace the whole process from preliminary planning down to the final documentation, covering the master audit strategy, profiling the client's business, the 3 audit risks, the materiality threshold, and finally, building the case file. Let's get started.
Starting right off with Part 1, the master audit strategy, or drafting the blueprint. We really have to begin our investigation at the very beginning, strategizing the approach to make sure the work stays controlled and the costs are actually reasonable. Now, before even looking at a single number, auditors have to do a rigorous background check. These preliminary engagement activities mean you evaluate client continuance, verify ethical requirements and independence, and establish the exact terms of the engagement. Basically, you have to be 100% sure you have the independence to do your job objectively, and you absolutely must verify that management possesses true integrity before you agree to audit them.
And it's really important to differentiate between 2 key concepts here: the overall audit strategy versus the detailed audit plan. The broad strategy sets the scope, the timing, and the overall direction of the audit. The audit plan, on the other hand, is much more specific. It dictates the exact nature, timing, and extent of the actual on-the-ground procedures your team is going to perform.
All of this planning comes together in what's called the Audit Planning Memorandum, or the APM. This master document contains the job timetable, any changes since the previous audit, key planning decisions, and assessment of the internal audit department, briefing instructions, and, of course, the time budget. Think of the APM as the ultimate blueprint. It formalizes the entire plan, tracks your time budget, and makes sure the proper tasks are assigned to the right members of the audit team.
Moving right along to Section 2, profiling the client's business or knowing the subject. We're transitioning into the profiling phase now, simply because an auditor can't effectively investigate a business they don't thoroughly understand.
In fact, the official guidance states this pretty clearly. Prior to acceptance of an engagement, the auditor should obtain a preliminary knowledge of the industry and ownership, management, and operations of the prospective client. Gathering this intelligence isn't just a nice-to-have, it's a strict requirement to assess risks and spot potential problems early on.
So where do auditors actually get all this intel? Well, they look at previous experience with the entity, hold internal and external discussions, review internal audit reports, study industry publications, conduct physical plant visits, and pore over internal documents. They're gathering clues from literally everywhere. Whether it's picking the brain of an industry economist or putting on a hard hat to walk through a factory, every single piece of data builds that profile.
Now, what's really interesting here is how wide the net is cast. Profiling details really matter. Auditors analyze everything from macro-environmental factors like national inflation and industry competition all the way down to micromanagement details, like the company's specific capital structure and who exactly sits on the board of directors. They have to anticipate issues from every possible angle.
That brings us to Section 3, the 3 audit risks. Let's shift into the tactical operation of risk assessment and identify the major hurdles in our investigation.
The absolute biggest hurdle of all is total audit risk. This is defined as the risk of giving an inappropriate opinion when the financial statements are materially misstated. Let's just pause on that for a second. Imagine giving a totally clean bill of health to a company whose books are actually riddled with massive errors. That is the absolute worst-case scenario for an auditor, a total nightmare.
And as you'll see, total audit risk isn't just one monolithic threat. It's actually a combination of 3 distinct, highly interconnected vulnerabilities: inherent risk, control risk, and detection risk.
Let's unpack the first one, inherent risk. This is the susceptibility of an account to material misstatement, assuming no related internal controls exist at all. For example, highly movable assets like cash or complex accounts that rely on really difficult estimations inherently carry a super high risk of error or theft, just by their very nature. Next up is control risk. This is the risk that a material misstatement will not be prevented or detected by the entity's own accounting and internal control systems. You see, while management actively tries to build strong internal systems to catch errors, there are always inherent limitations. Systems just aren't perfect, meaning some level of control risk is always going to remain.
The third and final vulnerability is detection risk. This is the risk that the auditor's own substantive procedures fail to catch a material misstatement. So the crucial takeaway here is this. If inherent and control risks are deemed to be high, the auditor has to perform much more intense, thorough substantive procedures to force that detection risk down to a safe level.
Now for Section 4, the materiality threshold, or weighing the evidence. But you might be wondering, how do you actually know if an error in the books is just a minor glitch or a massive glaring red flag?
Well, the answer is materiality. Materiality is a threshold where the omission or misstatement of financial information could actually influence the economic decisions of users. It's the definitive cutoff point, and it relies heavily on the professional judgment of the auditor to weigh both the quantity, like the actual dollar amount, and the quality or the nature of the error.
Furthermore, auditors have to look at the cumulative effect. A small, seemingly insignificant error in a month-end procedure can easily snowball over time into a massive material misstatement. An auditor's job is to zoom out and see how tiny, repeated errors can aggregate until they completely breach that materiality threshold.
Moving to our final phase, Section 5, building the case file. Let's organize our evidence locker. Remember, in the auditing profession, there's one golden rule. If it's not documented, it literally didn't happen.
The audit working papers act as the official record. They document the whole planning process, the understanding of internal controls, inherent and control risk assessments, analyses of transactions, and crucially, the reasoning on significant judgments. These papers contain the auditor's logic, their professional judgments, and the ultimate proof that the work met all required standards.
Let's see how this builds across two distinct files. The permanent audit file holds ongoing historical evidence. We're talking statutory rules, long-term leases, organization charts, and corporate history. On the flip side, we have the current audit file, holding the immediate active case details like current year accounts, internal control records, and recent schedules. It's a really brilliant way to visually separate ongoing context from immediate facts.
So, why the number 6? Well, auditors are strongly advised to retain their working papers for a strict minimum of 6 years. This isn't just a casual suggestion. It's absolutely necessary to protect the integrity of the audit evidence long after the job is actually finished.
We'll wrap up this explainer with a thought. If working papers are the ultimate proof of an auditor's integrity, what untold stories do a company's files hold about its true financial health? It really makes you wonder just how deep the financial detective has to dig. Thanks so much for joining me for this explainer, and we'll catch you next time.